Hey there, Brian Manning here with your weekly update. Let's talk about what happened this week in the markets and interest rates. So, Monday was a relatively quiet day for us. Not much coming out in the form of economic news. A lot of the trading that was taking place was based off the technicals. On Tuesday this week, we got a retail sales report that was delivered to us. And month over month, retail sales last month were down 0.9%. So a little bit of a cooling in retail sales and certainly lower than analyst expectations. Analysts were expecting to see retail sales up at about 1.1%. Also on Tuesday, we had the National Federation of Independent Businesses. That's a group of small businesses that gives us feedback of what they're thinking as far as the economy is concerned. And overall, small businesses on a national level feel that the overall economic improvement is down. And unfortunately, because of this, stocks were down on Tuesday in the markets. Thursday, we had initial jobless claims for last week. This tells us how many people filed for unemployment, and this was higher than expected. We had 290,000 initial jobless claims that were filed, and analyst expectations were of about 280,000. So that was certainly a difference. And then today, huge mover in the markets. Stocks are down significantly, bonds are down, and a lot of investments are moving their portfolio into a cash position right now. And this is for a couple reasons. First thing, China made an announcement that they're going to allow stocks to be used in short selling, and they also announced the availability of certain stocks to be used in this process as well. And these stocks that were announced that could be used were ones that were never anticipated to be able to be used in the short selling process. So short selling is kind of like using stocks as a margin account, and could be risky, and it has a lot of investors nervous there. And then for us here in the States, we got the CPI report today. So CPI is a consumer price index. It measures inflation over a month-over-month basis or year-over-year. So CPI year-over-year reading right now is down 0.1%, which is actually deflation. And predominantly this is from oil prices being down. But if we strip out oil, we now get to inflation, which is up 1.8%. And the big mover right now is that last month when we got the year-over-year rating, and we stripped out oil as well, inflation was up 1.7%. So now we're going from 1.7 up to 1.8%. And although this is not a huge increase, this is certainly a gauge that the Federal Reserve is watching, because they want to start raising rates, and they're using 2% as their target for increase of inflation. So 1.7, 1.8 certainly could be on our track to 2%. We'll have to wait and see what happens. So something to keep an eye on. I'll be around all weekend. If you have any buyers that you need to get pre-approved, you have any mortgage questions, give me a call. I would certainly love to help you any way I can and be part of your business. Have a wonderful day.